Welcome back. Today is Tuesday, March 17, 2026, and the markets are holding their breath. We are officially in the most consequential week of the year so far. For months, the narrative was normalization, a slow return to 2% inflation and steady rate cuts. But that story just hit a brick wall, between a sudden spike in Middle East tensions, an energy shock, and a labor market that is finally showing cracks. The Federal Reserve is trapped in a dual-mandate nightmare. Tomorrow, Jerome Powell takes the podium, and the dot plot he releases might just hit the delete button on your 2026 pivot dreams. Let's break down the chaos. First, let's look at the data that just hit the tape. Retail sales for February surprised to the upside for the fifth straight month, rising about 0.28%. On the surface, that looks like a win. The American consumer is a beast that won't stop spending. But look closer. Much of that growth is being driven by necessity. With WTI crude oil flirting with triple digits again due to the Iran conflict, gasoline is eating into discretionary budgets. While clothing and health stores saw gains, unit sales are actually declining. People are paying more, but they're taking home less. This is the definition of sticky inflation, and it's the exact reason why the Fed can't afford to be dovish tomorrow. Now, the main event. The FOMC meeting began this morning. While the rate decision itself is a 95% certainty for a hold at 3.5% to 3.75%, the real fireworks are in the summary of economic projections. Back in December, the Fed hinted at 1 or 2 cuts for 2026, but look at the landscape now. Unemployment has ticked up to 4.4% after that trainwreck February jobs report. Yet inflation is stubbornly hovering near 3%. If the new dot plot pushes rate cuts out to 2027, expect a violent repricing in the tech sector. Powell has to balance the risk of a recession against the risk of an unanchored inflation spiral. Watch his tone during the Q&A at 2:30 p.m. ET tomorrow. Any mention of geopolitical taxes or energy persistence is a signal. While the Fed deliberates, the supply chain is feeling the heat. The conflict in the Middle East has created a surge in fertilizer and energy costs. This brings us to Wednesday morning's PPI. Producer prices are the early warning system for consumer inflation. We're expecting a plus 0.3% reading. If it comes in hotter, it confirms manufacturers are passing energy costs down the line. We are seeing a low-hire, low-fire environment where companies are holding on to staff but cutting all other costs. If PPI spikes, that holding on to staff part might be the next thing to go. To top it all off, we have triple witching this Friday. Over $4 trillion in options and futures are set to expire. In a week this heavy with news, these expirations act like gasoline on a fire. Institutional investors will be frantically rolling over positions based on whatever Powell says tomorrow. Expect massive intraday swings in the S&P 500 and the Nasdaq. This isn't a week for day trading on gut feelings. It's a week for risk management. The bottom line, the Fed is likely to deliver a hawkish hold. They'll acknowledge the weak jobs data, but stay laser-focused on the energy-driven inflation. What's your move? Are you hedging for a dot plot shock? Or do you think the market has already priced in the worst? Drop a comment below, and don't forget to hit subscribe for the full FOMC breakdown tomorrow night. I'll see you in the comments.